Across the city, there's no shortage of stories about companies hiring and expanding in Ottawa. But where are they finding space to grow? Construction of new office and industrial properties has been lacking in some of the city's key commercial real estate markets. Hi, I'm Peter Kavesi, and I'm the head of content at the Ottawa Business Journal. Welcome to the Ottawa Real Estate Show, where we explore news, trends, and developments in the capital's commercial property industry. Today, we're looking at Ottawa's development landscape, exploring whether we are indeed facing a shortage of space, and diving into the factors that might trigger new construction. Joining me today is Hugh Gorman, the CEO of Colonnade Bridgeport, a local property manager and developer. I'm also joined by two sponsors of the Ottawa Real Estate Show. Daniela Sicoli-Zupo is a partner at Mann Lawyers, and Sean Hamilton is the managing director in Ottawa of real estate services firm CBRE. Thank you so much for joining us.
Thank you.
Let's set the stage, first of all, with a question to all of you. What is it like right now for tenants that are out in the market shopping for space? Hugh, why don't you start?
Well, I can only comment from a landlord's perspective, but certainly our portfolio is as occupied as it's ever been. We're seeing pressure on rental rates to move up as a result of the lack of supply. And so I think if you're from a tenant's perspective, it's a challenging time compared to what it's been, say, over the past 10 years. So we're seeing the space market tighten, rents increase, which from a landlord's perspective is a very positive thing.
Daniela, how about yourself?
I think I would echo that some of our corporate clients are expanding and probably noticing the same challenges in finding space for those expansions.
Sean?
Yeah, to put it in perspective, let me give you an example just of the Canada submarket. Right now there's about 460,000 square feet of vacant space and about 500,000 square feet of tenancies looking for new space. So clearly in that one market alone, we've got more people in need of space than there is space. And with that, to Hugh's point, comes rising rental rates, comes competition, comes less concessions from a landlord. It becomes more difficult for a tenant to find space. The same theme is happening downtown. It depends really on what size of a tenant you are. Larger tenants have few options. Smaller tenancies still have a number of options, but all in all, across the board in all markets, inventory is drying up and tenants are faced with less and less choice.
Let's take a look at what we could see as far as new supply coming online. Hugh, you've made the argument that it's relatively difficult for developers to construct speculative builds in Ottawa. In this regard, how is Ottawa different from other markets?
Well, I think just generally the absorption of space isn't as high here as it is in other major markets across the country. And as a result of that, Ottawa traditionally hasn't been a spec build market where landlords build buildings and hope that the tenants will come. It's typically one where you've got a pre-lease and you get a certain amount of pre-leasing done, get comfort that you're going to be able to fill the rest of the building, and then you get the green light from the capital partners to go ahead and proceed. So I think that's really the big difference, which actually has almost a supply constraint component to it, because we don't have competing buildings where they're building, basically on spec because they believe that the demand curve is going to follow and support that new development. So it does create an environment where there's less new supply available for tenants out there looking, and therefore it's not nearly as elastic as it would be in another market.
We're a small market too, so any development moves the needle quite significantly. So whereas in Toronto you could have a 500,000 square foot building that would just newly constructed, that would just blend into the countryside, here 350,000 square foot building will make a real impact and a dent on vacancy rates. So you almost don't want to undo the gains you've made in declining vacancy rates by putting a building onto the market. So again, using the word elasticity, Ottawa's very elastic in terms of its reaction to new supply. The other thing to add to that is Ottawa has been a tough pre-leasing market, mostly because most companies here, they're not head offices, they're divisions, they're not usually in markets where they have to engage in new builds. Not that they lack vision, but they're not wired that way, whereby other more head office-centric centers, Montreal, Toronto, Calgary, corporations will have the vision that will often kick off new development more easily than we see in Ottawa.
So of course, we spent the last few minutes talking primarily about the office and industrial market. One asset class where we're seeing seemingly no shortage of new developments is multi-residential projects. Danielle, what are you seeing on that front?
Traditionally, my clients tend to do a lot of the traditional type of condo buildings, residential, but what I've also been seeing a large increase in is the development of residential, primarily of retirement residence buildings, as well as student residence. There's obviously a need with the aging population for retirement spaces, some of which the developer will keep and rent out as landlord. The others are turned into condominium type units that they then sell to the public.
And how are these projects being financed?
They're getting funding, just project financing as well, and that noticed lately that there's been a lot of new lenders entering into the market, not your traditional banks, but things like Duca Financial or something like the BCIMC, et cetera. So there's a lot of new lenders entering into the market, and so that's providing for my clients at least a little bit more options and a little bit more opportunity for them to perhaps negotiate better terms and things like that for their mortgages.
Hugh, when you're talking to investors, how are they looking at Ottawa and particularly the opportunities for returns on new developments if they were to do construction here in Ottawa?
Well, we tend to partner on everything that we do with traditionally more institutional type capital. I would say that they look at Ottawa as an area of opportunity from the standpoint that there's been a lack of new supply, and therefore they see the opportunity to have less competition from a new development perspective, especially on the multifamily side. I would say that that's been the historical view, that yields are a little bit better here. There's not as much risk necessarily in this market. It's just that there hasn't been a lot of new supply to kind of look back and take a historical kind of benchmark view and to compare against. So there's maybe a bit more risk from that perspective. But ultimately, when the product comes up out of the ground, especially on the multifamily side, it's getting leased, and so at rates that are as good or better than pro forma. And so I think the confidence is building quickly. I think the concern that we have, if there is one, is there's been a lot of condo developers that converted their projects to multifamily projects when the condo market dried up. Thankfully, it's now coming back and is strong again. But there is a bit of a concern, as to where the demand is coming from, and is the supply and demand curve going to, fall into disequilibrium because of all the new supply being added. So I would say that they're cautiously optimistic, but the recent track record has been very, very positive.
Can I just ask a question, Hugh? Would you say that, so a lot of the investment market, there's been a trickle-down effect. So as the major centers, Toronto, Vancouver, have become price prohibitive from a cap rate viewpoint, there's been a trickle-down effect to Ottawa. Some people have used the terms Ottawa's a good beta play. Mm-hmm. Have you seen that happening in sort of the multi-res, whereby the interest in Ottawa has been because of affordability or saturation in other major markets in Canada?
Yeah, I think that's a part of it, for sure. There's no question. It's becoming difficult too in other markets. Just the planning cycle in places like Vancouver and Toronto is extremely long. And so I know there's a lot of people that will cringe that work in Ottawa when I say that the planning process here is actually pretty efficient compared to those markets, but it is. And so the cost of construction isn't as high, and just because there's so much construction going on, whether you're buying curtain wall for an office building or curtain wall for a condo building or curtain wall for a multifamily building, it's all curtain wall.
Yeah.
And so there's real labor and supply constraint issues in those marketplaces. So the costs are increasing dramatically. We're seeing construction cost increases on an annual basis in Ottawa. That's the rate they're going up quarterly in the GTA as an example. So there's a lot of pressure in those markets, which I think does make it attractive to come here. And so the question is, again, where's the demand curve going? Because we don't have a lot of historical growth to kind of look back on like those other markets do in terms of immigration and things like that. So I think everyone's kind of, I would say, more than dipping their toe in the water, they're kind of putting their foot in the water, but they're certainly not diving in headfirst into the deep end for sure. Yeah.
Just to turn back to the office and industrial asset classes, what are we seeing as far as rental rates? Is the higher demand putting upwards pressure on that, and is that getting higher? Are we seeing, as a result of higher rental rates, getting a bit more attention from outside capital?
Well, I mean, Sean, you'll know about rental rates more than I would. We're generally seeing rates going up for sure. Is there a connection between rental rates, in my view, and capital, I would say no. I think, outside of multifamily, it's the old, adage when, Toronto catches sneezes, we catch a cold. I do think there's concern about recession, and we keep hearing that a lot. You're seeing house prices fall in Vancouver and Toronto, and I think, there is concern about the overall economic condition, Canada-wide, and whether or not we're kind of at the peak of the cycle. And so I do think there's caution that kind of creeps in, and as a result of that, despite the fact that we're seeing the market tighten, rental rates go up, I think we are seeing capital generally taking, I wouldn't say a pause, but they're definitely slowing down in terms of their appetite, and they're concerned about values and whether or not they can hold. And as a result, you're seeing it's becoming, your investment team, I'm sure it's harder for them to sell assets right now.
And you got to remember, investment real estate is a truly optional form of real estate, right? Nobody has to sell, nobody has to buy. I mean, typically in Ottawa and downtown and Canada, investors have been drawn by the stability of the city. So government has represented a weather, or a calming effect on the market in terms of always taking a good portion of the market. The vibrancy of our urban tech has brought sort of a growth prospect to the downtown. But I also think if you look at the fundamentals, we have a tight market downtown. I think it will be tight for the next couple of years. And I think there is rental growth that could be happening in the downtown core, which helps take out some of the risk for investors, in that there is potential upside coming down the line. But as a general rule, they are very, very cautious. So any whiff of change on a global scale will have them take pause, not stop, but pause, just to make sure that everything that they do, certainly in Ottawa, is priced to perfection. So we're not seeing people leave, we're not seeing people lose faith, but we're just seeing people be more deliberate on their decisions.
We've identified some of the factors that influence development decisions. Just as sort of a final thought, what can the city and other policymakers do to make the environment more conducive to development here in Ottawa?
Well, I think have a vision that lasts longer than a typical term in office, which I think is what you're seeing happen now with LRT as an example. I think the city has a responsibility to, from a policy framework, both planning and infrastructure planning, making sure that we are being thoughtful as a city about growth and making sure that there's consistency in that approach. And so, as an example, the high-rise guidelines around within 500 meters of a transit station have been dramatically, I would say, loosened is the wrong term, but they're encouraging significant intensification because, in my view, I think everybody's view, the LRT has to be financially viable, and you need people getting on and off trains at transit stops for it to be viable. And so I think the vision that our political leadership has now, both municipally and provincially for the most part, but I guess federally too, are supporting the decision to go ahead with stage 2 of LRT was, I think, a very important, kind of, I would say, maybe a politically risky decision, as some would consider that, but I think that's the kind of leadership where I think our elected officials have to have that vision that lasts beyond their term, that supports, significant infrastructure that's planned appropriately, and then consistent policy to support those infrastructure decisions. And it's a huge benefit. It's driving development along the LRT. All the decisions that we're making, the capital that we've attracted, I can tell you, without LRT, we wouldn't be building residential buildings, and we wouldn't be bringing capital in, from other markets here to build that infrastructure and those multifamily buildings to support. So I think the city plays a leadership role. I think they can stimulate through good policy decisions and then following through consistently. And I think that leadership goes a long way to get then clarity for business around, making decisions around that policy framework and making commitments of capital to the market. So I think it's an incredibly important part of the appropriate development of our city over time. And I don't think you can completely rely on the private sector for that commitment to that infrastructure, and secondarily, obviously, to create the policy to support the capital investment around it.
The other thing to bear in mind is it's sort of a chicken and egg game. So the city invests in infrastructure with the hopes of increasing their tax base, right, through new development, through new growth. And we are running into a time whereby office space could run out. If you model it based on our last 5 years of absorption projected forward, we will literally run out of space in the time it takes us to deliver a new office building. So with that in mind, in this day and age of everything is instantaneous and we have a war for talent, and we're not just competing East End to West End, we're competing with Montreal, Kitchener, Waterloo, Toronto, Vancouver. If people don't have places to grow here, and I'm talking from a commercial real estate viewpoint, will they go elsewhere? Will they go to Waterloo? Will they go to Toronto? Because they can't afford to wait for new space to be developed. So to your question, what can the city do, is be as nimble as the economy needs them to be. So in terms of shortening development timelines, open up whatever good tracts of land that you've got, more so for an industrial front, and maybe do like you did with the Ottawa Business Park in the 80s and offer them at a preferential rate with a build clause in. And maybe also revisit your development charges in terms of now might not be the best time to raise them, because in doing so you might just chase away any new development that could be happening, or making it more difficult, potentially driving business to other parts of the country or other parts of the city. I give the example of VARS, where there's a bunch of industrial development happening there, which is outside of the city boundaries. Land is cheaper, development charges are cheaper, and people are finding that they're willing to go out there. And that's money that would otherwise have contributed to the City of Ottawa tax base. So maybe the city has to give up a little bit to get a lot in the end. That's just my 2 cents on that.
I agree with everything you said, except the land use piece. With respect to the city dictating where uses should go, outside of heavy industrial, but employment zones and things like that, I would not be a big supporter, not to take you to task. I mean, I totally agree with everything else you said. I just think the city should, I think they should stick to a policy framework that then lets occupants go where they want to go.
And I agree with you. My comment was more as it relates to industrial, in that in our industrial nodes, there's no land where people want to be. And so where can we put them that they're going to want to be? Because otherwise they haven't shown a willingness yet to be where the latest quote unquote industrial lands are. I don't even know where they are. I mean, there's not a lot.
We're out.
Yeah, we're out. So, but I agree with you on that. It was more as it relates to industrial real estate.
Okay, great. Oh, I appreciate you clarifying that point.
Unfortunately, we're going to leave it. We have to leave it there. But thank you so much for joining us, Sean, Hugh, Danielle. That was a great conversation. If you're watching this on YouTube or Facebook, you should check us out at obj.ca. I'm Peter Cavesi from the Ottawa Business Journal. Thank you so much for watching, and we'll see you again soon.